Nived, from a fund's perspective, when you start looking at assets or companies that you think are investable, is there an exit angle to it that is the first parameter that you consider? What are the parameters that a fund would consider, and how big a role does exit play in the whole equation?
So I'm going to kind of give you a perspective of, so I've never been an entrepreneur myself, but been very, very closely associated with Ganesh and Meena, who've kind of started off Startup2Startup and how that got acquired by Pearson, so I'll give you that perspective. But specifically with Pearson Affordable Learning Fund, we're a very long horizon fund, 7 years to 10 years. And with the situation or education situation in India post the EduComp era, so we really don't look at it as the only. That's one of the criteria. But from where we are and what kind of companies we're investing, this is extremely early stage idea-driven company. So it's more the idea, it's more the entrepreneur. So we believe that over a period of 5 to 7 years, if we can get the story right, then we can always look at Pearson, the geography, the entity in India, to kind of look at opportunities and try and see what comes into their portfolio or not. So that's really a very straightforward investment mandate from a fund perspective. But if you look at I just remember when David was talking, when Ganesh acquired EduRide, that was in 2007, and I think at that point in time he had raised about $2 million from Sequoia. He didn't even have an India business plan at that point in time, right? So he just had a US business plan, and and the idea was extremely novel. It was about tutoring kids with tutors in India. I think Sequoia in a very classic way just believed the entrepreneur, and I think over a period of time they figured that if you give him enough runway and time, I think a good entrepreneur can figure out the story himself. So if you look at his journey, I think from 2007 to 2010 is when he's built the entire scale. And from an India perspective, it was all about K-12, it was about getting into schools, ensuring that's a very, very strong tech overlay, operationally and so on. But did he think of exit? Absolutely yes, right? I think, from an entrepreneur's perspective, it was very, very clear that it has to be either the IPO route or the exit route. And looking at, where things were in the education scenario at that point in time, I think Pearson obviously is a very, very strong name which comes up from an acquisition mandate. And then Pearson at that point in time is a very, very strong inorganic strategy as well. So from that perspective, yes, it's a very well thought out, planned approach, but it's a question of time, it's a question of value. But if I flip to the other side, where we're investing in ideas, we're investing in entrepreneurs, I think it's more the idea, it's more the belief that if we believe in technology, believe in the kind of products and solutions entrepreneurs are getting to the table, I think we need to pack it up, and obviously we can come to a certain stage and think about exit and how do we take that forward. So I think that's really the perspective from both ends.